Today on Forbes, why Warren Buffett is an unexpected winner from Japan's market turbulence. Japan is weathering an economic hurricane. Japanese government bonds are suffering a historic sell-off, and the yen is sliding fast as investors panic over Prime Minister Sanai Takaichi's fiscal stimulus and proposed tax cuts. In the 10 days leading up to Wednesday, yields on the 40-year Japanese government bonds have eclipsed 4%, a figure not seen for long-dated JGB securities in 3 decades. For policymakers in Tokyo, a crisis is brewing. But for Berkshire Hathaway, the chaos has been good for business. The Omaha, Nebraska-based conglomerate has big equity stakes in Japan's 5 large trading houses, known as the Sogo Shosha, or general trading companies: Mitsubishi, Mitsui, Itochu, Marubeni, and Sumitomo. Shares in those and other Japanese corporations are on a tear as Japan's central bank raises rates to combat inflation after years of deflation. Over the past 3 months, Marubeni has jumped more than 30%, while Sumitomo is up over 40%. Amid the past week's volatility, all 5 stocks gained between 3% and 11%. Japan's Nikkei 225 stock index is down about 3% over the last 5 trading days leading up to Wednesday, but up 33% in the last 6 months, compared to the S&P 500 index's 8% return. Berkshire first invested in the 5 trading companies in July 2019, spending $6.5 billion in total to acquire 5% stakes in each firm. Between 2023 and last year, it spent another $7.3 billion on the 5 companies, boosting the size of its stakes. That $13.8 billion cash expenditure is now worth around $38 billion, a $24 billion gain. The Sogo Shosha are cash cows too. Berkshire said in its shareholder letter last year that it expected to collect $812 million in dividend income from its Japanese investment in 2025. Those yields are more than enough to cover the interest cost of Berkshire's yen-denominated debt, $135 million last year, which it took out to finance the investments. The investment epitomizes Buffett's smart buying. The yen-denominated debt he borrowed to acquire his stakes costs less than 1% per year, while the trading houses were paying dividends of about 4% per year. The performance of Buffett's Sogo Shosha investments offers a bright spot for Berkshire as it navigates a period of transition following the planned retirement of its CEO, founder, and largest individual shareholder, Warren Buffett, at the end of December. The 95-year-old, who remains chairman, is worth $143.6 billion. Berkshire's stock returned 11% in 2025, compared to the S&P 500's 18% return, as investors question the conglomerate's future without its talismanic founder and his stock-picking genius. Over the last few years, Berkshire, which has large positions in U.S. banks, consumer staples, and some $380 billion in U.S. dollars, has largely missed out on the artificial intelligence boom, except for positions in stocks like Apple and Amazon. Ultimately, Berkshire's Japanese investments represent only about 4% of the conglomerate's $1 trillion market capitalization. John Boyar, an investor in Berkshire, who runs the research boutique Boyar Value Group, says he's more preoccupied with the leadership transition to new CEO Greg Abel than he is about any one individual investment's success or failure. Boyar, who remains bullish on the stock, says, quote, "The real concern is what is the reign of Greg Abel going to do to the stock and to the Berkshire culture." Stock filings Tuesday night revealed Abel's first big move as CEO, to ditch its 28% or $7.7 billion stake in Kraft Heinz, one of Buffett's rare capital allocation missteps. In recent weeks, Japanese investors have viewed the Sogo Shosha as safe harbors amid the bond market dislocation. The Japanese companies, which themselves command a combined market value of $440 billion, benefit from the weakening yen, since they earn billions in US dollars while reporting earnings in yen. The currency conversion alone juices profits. Once a Japan skeptic, Buffett came to love the Sogo Shosha once he realized how much of a bargain they were, selling below their net asset values during the height of the pandemic. He also saw a kindred spirit in them. The trading houses, with their sprawling, diversified businesses spanning commodities, logistics, manufacturing, and finance, echo Berkshire's own conglomerate model. For full coverage, check out John Hyatt's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.